Hi, we see big upside in the small cap companies. It's not quite there yet in terms of timing, but there's big upside, 50 to 100% type of upside. I want to walk you through the technicals of the market so you can see the internals a little bit of what's happening. And then it's a good time to refresh ourselves on the fundamentals of the S&P 500. And then we'll hit why the small caps are so compelling. It'll pop out to you. It's a little bit unbelievable. So this is a great idea, and we hope you take advantage of it sometime in the next 6 to 12 months. So the technicals. You'll see that the upper end of the range of the S&P, roughly 4,200, the lower end, 3,800. We're in the upper end of the range. We're in an overbought condition, so we're not likely going to go significantly higher. We have seen the market broaden out for the first time in a while, that the advancing stocks are now above the declining stocks. So last week was 1,800 to 1,300 decliners. It had been 2 to 1 on the negative, so it's broadening out a little bit. There's been 6 stocks that's been pushing the whole S&P 500 up. So the S&P has gotten very narrow. This is consistent with a topping in the stock market. If you look at the S&P 500, it's up roughly 9% year to date. The S&P equal weighted is up 1%, as well as the Dow Jones and the Russell 2000. So the market itself is roughly flat, and these 6 stocks have been driving the weighted S&P 500 higher. It's even more severe or dramatic in the Russell 2000. The fundamentals of the stock market. So we look at 2 things. One is the earnings growth, and we'll review that quickly. But the other is the PE valuation. So what drives the PE is the yield on the 10-year Treasury. And lately, you add 1.6 to that. That's the risk premium. Sometimes it's different, but the market's been stuck on 1.6 plus the 10-year to equal the yield on the S&P 500 itself. Now, looking at the S&P 500 PE, you can see that you just take out this noise here. The market's really struggled to get up above 19 times over the last 10 years. So we think that's the upside. The current PE of the S&P 500 is 19 times this year's earnings. So if you take 1 divided by 19, that gets you 5.3%. If you take the 10-year Treasury plus 1.6, that gives you 5.3%. So if yields go up, that's going to really hurt the valuation of the stock market. Or if earnings go down, then we have another problem. Looking at the earnings. So we've talked about this over and over again, but the earnings have been revised down in a big way. If we go into a recession, those earnings are going to get cut again. But we've seen the first quarter earnings come in a little bit better than expected. So we've seen a little bit of improvement. And now the retailers are reported, we see a big disappointment. So we see what's currently happening is that the earnings are flattening out, but the consumer is starting to fade. So last week, Foot Locker reported a really bad quarter, talked about why, that the consumer is spending on non-discretionary items like staples and spending it on and not spending it on tennis shoes as an example. So they're spending on food, drinks, gasoline, but not on tennis shoes or other discretionary items that can wait. Now the valuations. Now this is why this will really pop out for you, that there's a big opportunity here in the small cap stocks. So if you take out again the noise of the pandemic and you look at that long trend from 2006 forward, you can see that the small cap companies, the green line, and the mid cap companies, the blue line, generally trade at a premium valuation to the S&P 500. But it's not. It's trading at quite a discount. Generally, those type of companies, the smaller names, they grow a lot faster, have more upside, get a higher valuation, but currently they are reflecting more of a recessionary scenario. Not quite all the way, but pretty close. So we see a big catch-up occurring in the valuations of small cap companies relative to large cap companies. But first we need the confidence that the economy is not headed into a recession or is coming out of recession. So the small cap names, if you look back over time, they get to 20 times earnings, and coming out of it, maybe a little bit more. So 20 times earnings, we're at 12. So that gives you close to 100% upside, particularly if the earnings start to reaccelerate again. But the timing is not quite there yet. So the market's stuck on this very narrow advance on 6 different companies. It probably won't broaden out until more confidence occurs in the economy. So to summarize, the valuations are not compelling for the stock market. They are very compelling for small cap names. We don't have confidence yet in the economy. We think we're probably headed for a recession. Once we get the confidence, the place to be is at small cap companies where we see big upside potential. It really sticks out like a sore thumb, doesn't it? So the small names look compelling. If you want to start to buy them currently, you can. But just keep in mind there's some events that likely will have to occur before you get the big move. IWM is the ETF for the Russell 2000. That's how we are going to play for our clients. So please take a look, and we will keep you up to date on the trends going forward. Take care, and please hit like. Go to my website, Patrick Adams CFA, and get our Market in a Minute update, where we'll send you an email every week. And we look forward to talking to you again.